What's up guys, Riz here. In this video, as promised, I'm going to be breaking down and sharing with you the top 6 stocks that I hold, have a position in already, and have a lot of conviction in for the medium to long term. So what do I mean by medium to long term? At least around 3 to 6 months, okay? And longer if it takes that much time. So without further ado, let's break it down. Let's get into it. Before I do though, let's quickly take a look at the S&P 500. Here I have the S&P 500 chart. If you haven't seen my previous videos breaking it down, please do so. Just click on the videos, tab in YouTube, and you'll be able to bring up the previous ones with doing breakdowns of the levels here. These are lines and these are key levels on the S&P 500 that I've had already. I didn't draw them, and take a look at how it's working out, right? You could see the S&P 500 with these candles very much so trying to stay above and successfully staying above the 4,300 area that I had drawn and mapped out in the beginning of the week. So you can see that, based on my experience and all that, these kind of levels are playing out and just as I expected. So the 4,300 to 4,400 levels, these two white lines here, are the key areas right now that we need to keep an eye on. If markets break below the 4,300, that can spell some downside. If markets bullishly break above the 4,400, that could mean we could go above to the 200-day moving average and move on to the next level. With that said, let's go into the actual stocks itself. It's important to have an understanding of the markets as a whole. That's why I outlined them. It's still looking kind of bearish. I'm still keeping an eye on seeing if we can hold that 4,300 level, okay? So without further ado, the first one on my list, the first stock is Netflix. Okay, I had a lot of people speculating when I asked, what my top stocks would be, and this one is, I'm sure, obviously, a stock that many of you, if not all of you, have heard of, and maybe this is something that's piqued your interest. Maybe you've looked at it yourself, or maybe you already have a position, right? But I took a position with this. The elite members knew about it the moment I did on Monday. What was it? Monday, January. Let's see here. Oh my God. Yeah. Okay. Monday, January 24th. Okay. So Monday, January 24th, I took a position here in Netflix. In fact, what just happened yesterday was Bill Ackman, the portfolio manager and the head of Pershing Square Capital Management, which is one of the more prominent hedge funds. He just unveiled his firm's large, I think over $1 billion position in Netflix. And in fact, I was, a little bit earlier than Bill Ackman, and I got in on Monday. So, it feels good to be right about that, especially before Bill Ackman, if that means anything. But ultimately, yes, this is this company that I, have traded many times over the years. I felt like it was very long in the tooth. It was a bit too frothy up around here, so I never took any position. I never really bothered with it until it started dropping, and you can see the Alpha Cross Evo really signaling a short position here, or a sell, and man, was it right. We got to pay more attention to that one now. But either way, big meltdown Netflix. It didn't help after earnings, even though they beat their subscriber numbers and weren't the greatest. Ultimately, it comes down to growth, and these companies are very much so based on potential growth. And for these kinds of monthly service type of companies, the subscriber numbers, growth, so on and so forth, is a key metric, even sometimes more important than actually beating earnings or beating revenue guide itself. So here we have the stock that's been absolutely decimated. I think it's about 40% lower from the highs. Yeah, about 44% from the high. So I have a position in this. It's a decent sized position. And you know what? I'm probably going to add to this as well if we see it hold, which I think it is. It's holding that, near the 400 level, bounced up from the 360 area. So this is looking really good. In fact, it was up 7% or so today on the news after the news of Bill Ackman's firm taking a position. So I've also highlighted here the annual kind of numbers here. The PE ratio, again, I'm not going to break down what these mean. You really have to take the masterclass, the stock trading masterclass, if you want to get an understanding how to get these numbers, where they're from, what they mean, and demystify them. But these are the few metrics that I've added up here. A PE of 35 is great. It was nearly double if you had bought sometime in the end of 2021. Look at their revenue, look at their sales, right? These are annualized numbers, as I've said, 28 billion, give or take, for the entire year, right, of 2021. And that is tremendous. In fact, this company makes a profit. We want to know if these companies make a profit. And I'll have all of the companies that I'm going to share with you, they all make a profit, okay? The annualized profit, and that's based on the income. Income's profit, same thing, about nearly 5 billion in profits. And that comes up to approximately a 15% profit margin. All right. And so this is a company that obviously the technicals make complete sense for more of a dip buy kind of knife cat situation, but also the fundamentals, right? You want to keep an eye on it. So I highlighted them for you. Another one that I really like, and this one's going to be no surprise for those of you that have been paying attention, is Amazon. Completely brutalized. Okay. Earnings is coming up in February, start of February. So in a week or so. And here I have also highlighted the fundamental kind of ratios here for you. Notice how the profit margins are low based on what Amazon does as a business. But man, look at their revenues for the year. Nearly $460 billion in revenue, okay? And a total net income, net profit of 26 or so billion dollars, okay? So that is tremendous. Yeah, their PE, their price to earnings ratio is high, the multiple is high, but I feel based on what Amazon is, it's a powerhouse, it's a juggernaut. You cannot compete against them in any industry that they get into, whether it be servers, cloud computing, whether it comes to logistics, whether it comes to packaging, whether it comes to anything really. If they get their hands in it and they get a foothold in an industry, you're in trouble. And they have a massive moat. What do I mean by moat? Well, do you see any other Amazon on the horizon becoming the next Amazon? No, there's similar ones, for certain regions of the globe. In South America, there's a similar one to Amazon. But Amazon is Amazon, and you know what? Whether you like it or not, it's here to stay. So this is another one that you can absolutely consider. I'm a really big believer in Amazon in the management. Of course, we need the markets to stabilize, for all these companies to stabilize and kind of recover, for these to also do really well. The next one I have here, again, these are not in any particular order, but you do want to make sure that you've done your due diligence, that you're okay with my thesis behind it, and then obviously you're aligning that to yourself and seeing, does that make sense? Is it okay for you? Is it okay for your account and your risk tolerance? The next one is Adobe. This one you've probably heard of, maybe not. This one has been a flyer of a stock. It's done tremendously well and was quite a bit overvalued, a bit frothy earlier at the end of 2021, just like almost everything else. But it's come down a nice amount, a solid amount. In fact, they had good earnings at the end of last year, and the PE of 49 is not great, but it's okay, right? For a growth company and for a software type of company, it's not too bad in the kind of environment that we're in. Sales of 15.8 billion almost, revenue annualized, again, an income of 4.8, profit for the year. And profit margin. So this is where software companies, you can see the nice profit margin, 35% compared to something like Amazon, which is a reseller of things on their marketplace, of 5%. So 35%, profit margin is extraordinary. It's fantastic. And of course, these companies, like I said, make money. This is a key level, a key support coming in here at this 500 full dollar mark. Okay, so keep an eye on that. Again, another great company that I like. Where are we at? We're done 3 now, right? We got 3 more. All right, next one. PayPal. Another online company, this time a payment processor, and very, very well situated in today's current market climate of transacting online, having mobility of funds, being able to send and receive money easily for products or services rendered. It's also not one of the major legacy banks, so it's a lot more online and more agile than some of these big banks that are pretty cumbersome and old school. So the PE ratio of 38, wow, this is completely hammered, completely oversold, and in really very much a value territory for what it is, which is very hard to come by. And I feel like this stock is very much overlooked by institutions and maybe even retail traders, right? With a revenue about nearly 25 billion for the year and an income of nearly 5 billion, that's tremendous. Take a look at the profit margins again, coming in at 20%. Again, it's an online company. It doesn't need big warehouses and a huge tens of thousands of different staffs and all that like Amazon does. But still, for the kind of company it is, it's fantastic. And some might even consider Square, but the problem with Square is it's a little bit more overvalued. It's under a little bit of pressure against some of the products that they offer, the services that they offer, like the Square thing that can just plug into your phone. Apple, there's rumors that Apple might come out with something similar to what Square offers, but without needing any physical hardware attachment to your phone. So that's a bit scary. So that's why Square is not on here. I prefer PayPal. And you know what? It's, I think, in a very, very undervalued kind of territory for a tech growth type of stock. Next, two more. And this time I have a very beloved company of pretty much everyone I speak to, Nvidia. This one has had a tremendous 2021. And it was a bit long in the tooth. I felt like it was a bit overdone. Even now, someone could make the case that look at the PE, Riz. It's 67, nearly 68. It's quite overvalued. But we know the PE ratio isn't everything. We've seen companies with hundreds of PE, or if you were Tesla up until 2020, a negative PE of 1,000. So really, it doesn't really matter in the grand scheme of things. It matters somewhat, but it's not everything, right? So look at the sales and income. Look at the sales, about 25 billion almost in revenue, and of course an income of about 8 billion for the year. And then again, stellar profit margins. This company makes chipsets, semiconductors for graphics cards, for servers, for even your cars, right? So of course, a very well insulated with a company with a large moat in an industry that is obviously set to grow. It's just a bit up in the air. The reason being because of the supply chain problems, the shortage in wafers and not chips like physical eating chips. I'm talking about wafers and chips for going into your cars, into your PCs, your laptops, your phones. There's a shortage of the raw materials needed, and that's causing a supply chain crunch. As a result, it's kind of pressuring the amount of products that Nvidia can create and sell. So that's a little bit of a bottleneck. But right now, I think this is a great opportunity to consider. I'm not saying it can't go any lower, but for those of you that have maybe been waiting for an entry into Nvidia, fantastic. A bonus one that you might want to consider is AMD. Okay, AMD is also a fantastic one. It's either this or AMD. You kind of pick your favorite here. They're both great. Nvidia obviously has a lot more. I would say it's a bigger company. It's more true, tried and tested. AMD is absolutely a great company, a great growth company. But you know what? It's a smaller one. All right. So you can consider this or AMD, whichever makes sense for you. And last but not least, I have everyone's favorite shoe company, Nike. Okay. Now, this is a company that is not a growth stock per se. It's not a software company. It's not a tech company. So this is quite a bit of a different from the other five. And this one, of course, as we know, sells shoes. And with a revenue about 46 billion for the full year, with a net income about 6 billion, that's tremendous. It's fantastic. All from selling all different styles of shoes, right? And their profit margin for a company that sells a physical product like a shoe, 13%. It's pretty solid. Remember, these are annualized numbers for the past year. This year's numbers will change, of course, as the year progresses. And with a 37, nearly 38 PE, not too bad. Could it go a little bit lower? Yes, of course, with the market. And I think this is definitely something you want to keep an eye on. It's approaching, it's completely, downfill that gap of before. It's kind of approaching that 135, 140 area. If it does, it makes it even better of a company to consider, right? So those are the 6 stocks. Hopefully, maybe you've heard of them, maybe you haven't. Hopefully you gravitated towards what I've talked about. Maybe it's piqued your interest, in these companies, and hopefully you appreciate kind of a little bit of a fundamental breakdown alongside the technicals. And you know what? Let me know in the comments below what you think. And of course, if you haven't subscribed, you haven't liked, please do so. It means a lot. Please like, share, comment, all that good stuff. It really, really goes a long way in helping me, the team, and the channel grow and reach an audience so that they can benefit just like I hope you have. All right, so thanks a lot. Keep it locked. Please enjoy all our other videos. Check them out. And guess what? If you have any questions, concerns, feel free to send me an email or reach me on any of our social medias, and I'd be happy to answer and get in touch with you. Cheers. Have a good one.